Greetings, good people. Hopefully you had a good Labor Day weekend with your friends, family, and such. Any of you were affected by the hurricane last week, our thoughts and prayers are with you, as well as our friends over in the beautiful state of Hawaii. Given this was Labor Day, I thought I'd start with the labor numbers. The JOLTS. What are the JOLTS? For most folks that have a life, that is the job openings and labor turnover numbers. And so these numbers now presented a little bit more of a murky gray area as showing a slowing economy. So job openings, which dropped 3%, the largest amount since 2002, quite a while ago. I was actually young, not as much gray. Labor turnover. So unemployment ticked up, 75,000 jobs lost last month. Now, interestingly, when we start to look at the dichotomy of these numbers, when Jay was actually asked, a couple of weeks ago about, what's going on, it was good to see job openings going down without affecting the unemployment rate to the upside. That wasn't until last week. So we shall see the adjustment in the playbook for the Fed as the board may look the same, but they're starting to realize that the checkers are being replaced by rooks, bishops, queens, and knights there. So now, as we maneuver past that, we looked at payrolls down for both corporate and government, okay? Again, showing that slowing job market. So again, this is now, as things work their way through the system, we're starting to see this. Now, the Fed loves their favorite is the PCE number, which again came in at 3.3, core PCE at 4.2 last month, which was just in line. So nothing overly hawkish there, just kind of holding fort, but the job number is now showing some cracks in the proverbial armor. Now on the employment front, since it is Labor Day weekend, wanted to also go over, we do have obviously a larger amount of striking workers, over a couple 100,000. A lot of that is due to the writers, actors, which I know a lot of you that love your network TV or cable TV dramas and comedies and all of that may notice. However, the big looming strike out there is the UAW. So we definitely have our finger on the pulse of that as well. Now, as we maneuver through, we look at home prices, right? So again, we know, and if you're on there on Redfin and Zillow, I know you are. My kids like to look at that. They get their little reports where the home prices are. You'll notice that, especially here in the state of Florida, does vary, but for the most part, because of the supply, right, demand metric, home prices have remained pretty sticky. However, that's because most folks aren't moving. They're staying where they are. They don't want to go from a 3% rate to a 7% rate. Who would do that? Well, and here's the reason, if you haven't done the math on that, a $500,000 house, $500,000 back in 2021, at a 3% rate would come in at a $2,100 a month mortgage payment. That same home, 2023, $500,000, now at 7%, comes in at $3,300 a month, obviously. So now people aren't moving, but what does that do? That slows the economy down, right? Because a lot of the trickle down, your Home Depots, your home improvements, et cetera, to homes that they're moving in, not just the ones that they're in. A lot of them have already done a lot of improvements since COVID, the lock-ins, right? Lockdowns. So this is definitely almost think of a bike chain, but not enough lubrication really slowing things down. And what are the ramifications of that? Now, to throw another banana peel on a proverbial floor for the Fed as well is energy. Now, many of you have been participating in the energy trade in your global macros, your velociraptors, more recently in some of your ETF models like Sector Momentum. However, surprise though, when you watch the news channels, they talk about it as a trade. However, the effect on inflation should really be what they're looking at. Not only that, but our economy as a whole. Now, it is a dichotomy because it will slow down economic activity, right? But it's also going to keep inflation higher. So again, talking about playing chess now, we hope, again, the Fed realizes they have no control over energy prices, and raising rates will only exacerbate the situation. So we believe that they will figure out that a change-up versus a fastball is coming. Again, what's the difference between a change-up and a fastball, as my father used to tell me? The speed, the arm motion looks the same. In other words, inflation may be higher, but it's a head fake because energy cannot be controlled by what the Fed is doing. In fact, very little can, except weakening the economy. I won't get into the macroeconomics on that. So when we look at energy, again, you're looking at two things I want to talk about. The BRIC countries, right? You know them as Brazil, Russia, India, and China. Your large emerging markets and such. More developed emerging markets, I guess you could say. They've now sent out invites, right? Just like college football, the SEC, the Big Ten, the ACC. Don't get me started on that one. But they sent out invites. And instead of schools, these are countries. If you haven't seen it, because you're probably not going to see it, on DirecTV, I watched Channel 200, all news channels, haven't seen it. Didn't see it on CNBC, Fox Business, or Bloomberg. But do your homework, you'll see it. Saudi Arabia, Iran, and the UAE are the invites. And we know they're going to accept them. So what does this do to the energy dynamic? Well, Russia's already trying to keep prices higher, right? Harming the West and as such, keeping the dollar at bay as well. And you add two more of these players to that. It's almost like a quad as far as the energy components, to use an overused term. So again, that puts a lot of control overseas and not necessarily our best friends' hands on the energy prices because we're no longer energy independent. I'm not going to get into that. You're not going to get me into a blue or red. We think green. It's just a fact. So what does that do? That tilts the board. If you looked at prices at the pump, in the upper threes, just under 4. It's the highest this year. Now, it's not as high as the 5s. It was in the 5s last year. It's still in here, but that mercury is rising. So what does that do? Especially to folks making less than $50,000 a year, food and energy are a larger portion of what they're spending on. That decreases spending on other areas. Okay? So now, you may think that I am painting a doom and gloom picture here, but for markets, we always talk about, right, Main Street, Wall Street, do not confuse the two. Actually, things are looking quite sunny for markets right now. Now, we had a pullback in August. A lot of people calling in, Jonathan, and our personal wealth advisor, hey, I'm down this month. Everyone's getting used to the Kool-Aid from early part of the year, but it ended up being a normal pullback. Now, I'm talking about ended like I'm projecting. I'm just going to tell you historically here what we're seeing in the patterns and as such. First of all, historically, when you've had an S&P 500 above 10% for the year, and it was down in August, 100% of the time, it finishes the year positive from September to December. In fact, more specifically, the average rate of return is at 9.9%. So as you notice in your strategies, that we may have, and more active strategies may have hedged a little bit, very slightly, we remained still with a risk asset bias. Okay, what that means more in equities, okay, and risk assets for your home gamers there. And so, again, you had some clients saying, well, hey, what's going on here? Should we be more defensive? And the National Association of Active Investment Managers, as we reported last week, went all the way down to 40% in equities. They've now raised it to 60% because they can see where the technicals and historic patterns are moving. We never really got that bearish. We just started to, again, look at where that brake pedal was, but not mashing it. So here's the deal, though. Usually the first couple weeks of September are not the worst, because September as a month is the worst historically of the year. However, not after a negative August, with, like we said, a double-digit gain for the S&P year to date. You got to do a little bit deeper digging. You got to go below the surface level. And so, September's a terrible time. I got to go a little surface level, just like in our communication, right? We can all use a little help there. From that standpoint, right? It's just conveying things. When you look beyond the details and deep, the market looks pretty bullish right here in certain sectors. So with that being said, how can I forget? I saved the best, hopefully the best, for last. The Schwab TD Ameritrade conversion. For a junkie like me, I can't log in this week. Thankfully, football started. Got friends, family, pool, football. But I like to log in every once in a while. You cannot. They've locked you out. Your Ameritrade Schwab, that pumpkin, they're telling us will be a stagecoach. 5 a.m. is it, Schwab said on Tuesday morning on the 5th? We shall see. But in all seriousness, if you have any difficulties, we're here for you. Hold your hand every step of the way. As again, we serve you. So if you have any problems logging in at all, let us know. As we also, I believe Schwab has muscled up on the back end as well, on the customer service end, to make sure that everything goes swimmingly. With that being said, hopefully you're enjoying the pool, the weather. For those of you recovering, our hearts go out to you. Other than that, Godspeed, stay frosty, and let's see what September brings.